On Business Incorporated today, 5 countries to get $54.5 million for investments in sustainable development goals. Nigeria's consumer price index dropped month on month to 15.6% from 15.63. Egypt's unemployment and trade deficits drop. Hello, welcome to the program. This is Business Incorporated on Channels Television. I'm Ini John Mekwa. We begin as usual with markets in Africa, where trading numbers were mostly positive. As intraday, the NSE index was down at intraday 0.22%, continuing yesterday's bearish sentiments, while the South Africa's JSE jumped by almost 1%. Elsewhere, the EGX 30 in Egypt was also trading in the green territory. It was up slightly, 0.13%. Kenya ended Monday's session negative. In the UAE, Dubai's main index posted a stronger gain of 0.77%, while the Abu Dhabi index was also up, but it was not as much as that, 0.43%. Elsewhere in the region, a different story with Qatari and Saudi Arabia markets in the negative territory, down 0.19% and 0.04% each. Well, let's go to Europe now. Russia is said to be pulling out its training ship, that's what they call it now, from the borders of Ukraine. Well, let's get reactions. We've been on this story, reactions from the market. Now let's get more reactions from Berlin with Stephen. Stephen is joining us from Berlin now to tell us how the market is reacting to this update in the Ukraine and Russia issue. Hello, Stephen. What's going on there?
Well, we saw that on Monday, markets in Berlin, Paris, and London all fell as investors reacted with concern of what's going on in Ukraine, tensions around Ukraine. We've seen in particular that gold prices have risen. We've seen that oil is reaching a 7-year high as it inches closer to $100 a barrel. We've also seen that here in Europe, investors are willing to pay more for German bonds, what's considered to be Europe's safest asset. There are special concerns here around energy and what could play out around energy costs should the conflict itself or sanctions against Russia or perhaps counter-sanctions from Russia against Europe and the West play out in the coming days, weeks, months. Energy prices already being high, and we mean here gas and oil in Europe as well as in the world, and that could further worsen that situation.
And Germany has faced pressure from Western allies on its position, with the Russia situation. To what extent do economic reactions respond between the two countries?
Culturally and socially, Germany has placed a large emphasis on having good business ties, good diplomatic ties with Russia. There are historical reasons for this. One is, of course, Germany's actions in World War II against Russia. The country post-war Germany sees Russia as a special victim of Nazi aggression, but also the Cold War relationship between the Russian-led Soviet Union and the former East German state. Those relationships, those memories are still very strong in parts of Germany, and there is always an outlook here that's business friendly, and that of course is very typical of German relations with other countries in general, is that there is often a very strong business role, and that's no different in Russia, where in the last 5 years 8 billion euros worth of business between the two countries, or rather I should say German investment in Russia. That's according to the German-Russian Chambers of Commerce, and there's a fear there that that could be at risk if any conflict should take place, if any sort of sanctions should take place. The head of that organization saying Monday that the relationship between Germany and Russia has held up even in the darkest moments of the Cold War, and calling for that relationship to keep going forward and for politicians and business leaders to not take any rash actions in the days ahead. So some concerns there that steps could be isolating for both sides of that business equation. But of course, at the end of the day, there's also the fact that the relationship between Germany and Russia is defined by that energy relationship. Germany heavily dependent on Russian gas, much like Europe, but even more so than other European countries. And so that is seen as a weak point, some would say, in its negotiations with Russia, as potentially leverage that Russia has. Germany has often said that that's leverage it has against Russia as well, because it needs Germany as a big customer, but some outside observers doubt that. So really energy politics also playing into what has been a cultural relationship and a cultural emphasis on relations with Russia as well.
Well, we do hope that at least we're seeing the end of this conflict. But what could the conflict mean for German and European economies?
Well, it wouldn't be good, and that's why we're seeing markets already reacting. What you would want to watch is what happens with those energy prices. Are they going to spike as traders fear that futures could rise, as traders fear that prices could rise? Gas and oil really being the ones to watch here. You'd want to watch those major indexes as well. What you also want to see is what it could mean for what that ultimately will mean for homes and businesses here across Europe. That could mean that things like prices at the pump, gasoline, would rise pretty quickly. That means that the price for heating, for gas heating, would rise pretty quickly. And for everyday substances that are affected by rising energy costs. This plays into a very sensitive moment right now across Europe, as inflation is already high due to those rising energy costs. And those costs can't really be controlled at the moment by governments and by central banks. All that they can do at the moment is try and provide relief to consumers. So there is a lot of concern that something that's even more out of their hands will play out in the coming days and weeks, driving up those energy costs, driving up inflation, prices for normal citizens, and that could, of course, lead to more dissatisfaction across Europe.
All right, Stephen. Well, thank you so much. We do hope to hear a different story from that region after what Russia has called its training ship leaving the borders. Well, let's move now to the UK. 2022 has been called the year of the squeeze, but relief may be coming the way of employees if the January data from the Office for National Statistics is anything to go by. It shows that there was pay growth for the month of January. Well, we have Juliana now to tell us what this really means. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
So how impactful is this growth that the data is showing us?
I may have lost you, Innie, I'm afraid.
Okay. All right. So I was asking how impactful...
You're back. You're back.
Yeah. Okay. So how impactful, really, in the face of the energy costs, inflation and all that, how impactful is this pay rise that we're hearing about?
Yeah, it's pretty interesting. So the headline figure does say that wages grew by 3.8%, but once you adjust it with this high record, 32-year high record of inflation in the country, then it's actually a pay drop. So wages have actually fallen by 0.8%, and this is all down to figures released by the Office for National Statistics earlier this morning, looking at the labour market in the UK. So the good news is that unemployment is still falling. It is about 4.1%, about 100,000 people were added to the payroll in the UK. But wages are not going as far as inflation, which is why there is so much pressure for the Bank of England to once again raise interest rates. They did it a couple of weeks ago from 0.25% to 0.5%. There are some economists that actually predict interest rates will be up to 2.5% by the end of the year to curb back inflation, which is likely to peak at 7%. We're going to have a look at January's data tomorrow. So yes, unfortunately, as the cost of living is increasing, and we're expecting more of this in April when the national insurance tax goes up, the energy bills rise, wages are just not going far enough. So yes, there is that headline figure of 3.8%, but in real terms is actually a contraction by 0.8%. And I think anybody watching this in the UK will agree with that.
Yeah, so it's still a year of the squeeze for the UK, and I think for many countries in the world. Okay, so moving away from that, derivatives clearing houses will no longer have access to the European Union after June 2025. Of course, this is another fallout of Brexit. So what options will they have left? Where do they go from here?
Well, the option left for financial transactions will be that the clearing takes place onshore. So the clearing is really a financial institution which works as kind of the platform for those exporting and importing to use. Nothing has really changed since Brexit, but we know that financial services between Brussels and London have been, shredding away for the past couple of years. So now these clearing houses have about 3 years left for access to both Brussels and the square mile. Very complicated, but a very interesting and important piece of apparatus because we know that firms are cutting costs, cutting out the middleman, trying to be more energy efficient, and they use these clearing houses to perform such tasks. But now that they're going to be cut off from using any of them in the EU, it begs to question. But I suppose the Chancellor and private sector bosses have got a couple of years to try and find a solution now.
And how's the market as intraday?
Yeah, the market's doing well. There was a massive sell-off yesterday as there were fears about Ukraine, Russia. There were reports this morning suggesting that Russia's troops on the border, 100,000 troops that they've amassed, are pulling back. Although we have just been hearing from Jens Stoltenberg, the chief exec of NATO, who begs to differ. So there is lots of confusion, but there does appear to be that the window of diplomacy is creaking open, which has cheered investors. So the all-share is up 0.73% at intraday. The FTSE 100 is up by 0.65%, and the FTSE 250, that's also up by 0.92%. In the currencies market, the British pound is trading up against the US dollar by 0.12%. It's trading down, though, against the euro by 0.26%, but the British pound is trading up on the Japanese yen at intraday by 0.23% in A.
All right, Juliana, thank you so much. We'll do it again tomorrow. Enjoy the rest of your day.
Definitely. Thank you.
Let's move to Asia now, where shares were mixed as investors in the region continue to monitor tensions between Russia and Ukraine. Well, it's affecting every market now. Japanese stocks closed in negative territory with the Nikkei 225 down 0.79% to almost 27,000, while the Topix index declined almost 1% to almost 2,000. Mainland Chinese stocks, on the other hand, closed higher. The Shanghai Composite gained 0.5% to 3,444.09, while the Shenzhen Component jumped 1.69% to 13,345.63. Hong Kong's Hang Seng Index declined about 1% as of its final hour of trading. Elsewhere, South Korea's Kospi finished its trading day over 1% lower at 2,676.54, while the S&P X 200 in Australia declined 0.51%, closing at 7,206.90. MTSI's broadest index of Asia-Pacific shares outside Japan shed 0.31%. In the United States, stock futures were positive as intraday as traders kept their eyes on the simmering tensions between Russia and Ukraine, while weighing the potential impact of tighter monetary policy from the Federal Reserve. Futures tied to the Dow Jones Industrial Average was up more than 1%, while S&P 500 futures sat close to 2%, and Nasdaq 100 futures advanced even further. Wall Street is coming off a volatile Monday trading session. The Dow closed lower by 171.89 points after falling more than 400 points at one point. The S&P 500 dropped as much as 1.2% before ending the day 0.4% lower. The Nasdaq Composite fell 0.9% at one point before closing just below the flat line. More than 70% of S&P 500 companies have posted their latest quarterly results, with 77% of those names beating analysts' expectations. In the oil space now, prices fell today as investors took profit from previous day's rally to 7-year highs, and as global stock market slumped, although losses were capped by fears that Russia might invade Ukraine and disrupt supplies. Brent crude futures was at $96.19 a barrel. That was down 29 cents, while U.S. West Texas Intermediate crude dropped 36 cents to $95.10 a barrel. That was after gaining $2.36 the previous day. Both benchmarks hit their highest since September 2014, with the Brent touching $96.78 and WTI reaching $95.82. Russia is one of the world's largest oil and gas producers, and fears it could invade Ukraine have driven a rally in oil towards $100 per barrel, a level not seen since 2014. Investors are also watching talks between the United States and Iran. The Iranian foreign minister has said it was in a hurry to reach a swift agreement in nuclear talks with Vienna, provided its national interests are protected. We'll take a break now. When we come back, we'll do Africa, especially see what's happening in the commodities market. To stay with us is Business Incorporated on Channels Television. Welcome back. You're still watching Business Incorporated on Channels Television. In the commodities market space now, the domestic price of fertilizer is rising at a faster rate than global price, with a bag of fertilizer rising by 172%, going from 5,500 to 15,000 as against the global price, which has risen by 30%. It's about $90 per ton now, and that's within a month. Well, we have Abimbola Digun, analyst with Financial Derivatives Company, now joining us from Victoria Island to put a perspective to this. Hello, Abiola. Good afternoon.
Good afternoon.
So considering the production capacity of Indorama Eleme Petrochemicals Limited and the chemicals industry, as well as Dangote fertilizer plant, which seems to exceed domestic demand, help us to understand why the price is still running at this rate.
So we have, yes, we do have the capacity to produce a lot of fertilizer. However, we're not making fully utilizing the capacity that we have. So we're not making as much as would meet the demand. And this has caused shortage in the supply of fertilizers, and this has increased the price. Also, people are taking advantage of the attractive exchange rate prices in other neighboring countries in Africa, and they are smuggling fertilizers to other countries so that they can make some sort of profit. The government also has removed subsidy from price of fertilizer, and this has pushed farmers and blenders to the open markets, and this is why they are buying a bag of fertilizer for as high as 15,000 naira in Nigeria. So these are like the points. These are the reasons why there's still increase in price of fertilizer compared to production capacity.
Yeah, so the issue of food security, because mostly fertilizer is used for crops, which of course feeds into the issue of food security. How does this feed into it? There's already the risk of food crisis in Africa. The threats to food security is something else in Nigeria. So how does this impact the scenario that we already have, which is not looking so good at this time?
Okay, so a lot of farmers in Africa are very dependent on importing fertilizers into the country. And because there's an increase in the global price of fertilizers, it will definitely increase the price of fertilizers in Africa or in countries in which they are importing these fertilizers. And an increase in the price of these commodities would further worsen the food prices in Africa. Also, Africa is known as the poorest continent in the world, and this increase in price of commodities is going to further push people below the poverty line, and this would cause some sort of scare or social unrest amongst the people within Africa. So these are the reasons why, these are the effects in which the increase in global price for fertilizers would affect African countries.
So the MBS released inflation today, and we saw from there that food inflation tapered for the month of January. Do you see this bringing another maybe increase in food inflation in the nearest future?
So we need to take note that there's a lag between the time when increase in price affects inputs and when the market responds to it. Now, these figures that we're getting, this decline in inflation is just for the one for January, right?
Yes.
But
yes.
Recently, diesel and petrol there was a spike in the price of diesel, and this is transport costs. This affects transport costs, and this would affect you'll see it reflects on the price of commodities. Also, we're in the planting season, no longer the harvesting season. This would cause shortage. There will be a reduction in the supply of commodities, and this will lead to an increase in price of commodities. So not to talk about the fertilizers I just said now that the price has increased globally. So all these things, if you put them together, they could possibly have an effect on the price of inflation moving forward. So we shouldn't be too comfortable with the fact that inflation has dropped just a little.
All right, thank you so much, Abimbola Digun, analyst with Financial Derivatives Company. Thank you for sharing your thoughts with us this afternoon. Enjoy the rest of your day. So from there, we go to where the United Nations Joint Sustainable Development Goals Fund has announced an additional $54.5 million in investments for projects across 5 countries to put the SDGs back on track. Kenya, Madagascar, North Macedonia, Suriname, and Zimbabwe were selected from proposals submitted by more than 100 countries as being the most impactful and investment-ready to take public. The fund offers a sustainable investment model by leveraging the power of markets to accelerate businesses, empower communities, and provide clear path to self-sufficiency from health in a world still plagued by COVID-19 pandemic to youth empowerment and climate change. The UN believes that investments will respond to the challenges of this time. And then we come to Nigeria now, where Nigeria's headline inflation rate fell marginally by 3 basis points month-on-month for the month of January. And that's according to the latest report by the National Bureau of Statistics. A brief breakdown of the data shows, as you see on your screen, that headline consumer price index, which measures changes in the price of goods and services consumed, dropped to 15.6% last month from 15.63% recorded in December. At the same time, food inflation index was also dropped 17.13% in January against 17.37% in December 2021. The report further shows that core and urban inflation were unchanged within the comparative period, while rural inflation was lowered from 15.11% to 15.03%. Meanwhile, the MBS report mentions that Kogi State recorded highest rates of food inflation, I beg your pardon, at 22.61%, while Sokoto recorded the lowest food inflation at 14.18%. Well, still staying in Nigeria now, the country's President Muhammadu Buhari, has submitted the 2022 Appropriation Amendment proposal to the National Assembly. In the letter, President Buhari said the amendment is necessary to accommodate some issues in the country, including fuel subsidy, which must be considered. In the letter, President Buhari is asking the National Assembly to approve the sum of 2.557 trillion naira as supplementary budget for petrol subsidy from July to December 2022. We move to Nigeria now. Let's go to Egypt, where the country's unemployment rate fell slightly to 7.4% in the fourth quarter of 2021. The rate was 7.5% in the previous quarter of 2021. Egypt's trade balance deficit also dropped by 63.1% to $1.19 billion in November 2021, as compared to $3.22 billion in the same month of 2020. Meanwhile, the value of Egyptian exports surged by 80.6% year-on-year to $4.48 billion in November 2021, and it came from $2.48 billion. Egypt must be doing something good there. The agency attributed this surge to the increase in the value of some goods exports, including fertilizers, fresh fruits, and ready-made clothing by 83.3%, 50.2%, and 31.5%, respectively. That's it on the program for today. Thank you so much for being a part of it. Let's do it again tomorrow. I'm Ini John Mekwa.